think, act, and prosper. You are now tuned into the Money Level Show.
Start that. All right, y'all. Thank y'all for joining today. This is just basic investing presentation. Just a disclaimer, I'm not a financial advisor. I'm only sharing the knowledge I've obtained over time. This presentation is for informational use only. Investments involve risk, so any risk that you take, I am not liable for any losses that may occur. If you're interested in financial advice, be sure to contact the financial advisor or securities dealer. So that's pretty much my disclaimer. So just a quick question. So why do you want to invest? So
I say partly to I say partly to like build wealth rather than just like be rich kind of idea. To really like build wealth over time. And as well as, I mean, it seems like everybody who is wealthy, they invest. So partly because it's a little bit of like a following what people do that I look up to.
Okay. How about you, Tony?
Well, for me, it's to have a better life. But my main goal is to make sure my kids are taken care of, long after I'm gone. And I don't expect to be gone anytime soon, but I'm hoping that my kids are taken care of when that time does come.
Yeah, definitely. So yeah, there's a few reasons why I invest. One of those is well, both of y'all agree with both of y'all. That's definitely a reason why I choose to invest. Because I want my kids to be taken care of too. So one of the key things for investing is you want to fight against inflation. You want to make your money work for you, building generational wealth, early retirement, good stewardship, and paying yourself first. So those are a few different reasons of why people invest and why you should invest. For me, I don't want to retire when I'm 70 years old, because I'm sure they're going to push the age to probably 70, 75 by the time I'm that age. They keep pushing the age back. So I'm not trying to retire then. I want to enjoy life. I want to be able to travel, things like that. Also good stewardship. One of the parables I really cling to is the parable of the three talents. Two of them invested their money, made it grow, and the other buried the money and went back, and the master pretty much was just like, what are you doing? Why didn't you make this, what I given you, grow? So so that's another key point: building generational wealth and fighting against inflation. So inflation. So the biggest thing about inflation is that inflation kills your wealth. Anything that you save in the bank, inflation is going to kill it. As you can see from this graphic over here from Investopedia, a cup of coffee in 1970 cost 20 cents. I'm sure that's just drip coffee. And then now in 2019 was $1.59 on average. So, and I'm sure it's more expensive up here. So in Washington. So inflation kills your wealth. I've stated in a few of my podcasts and stuff that that the dollar used to be $1 used to be worth $29 worth of goods and services today, and that was in 1908. So the dollar has been designed to fail. The dollar has been designed to lose value, and it's already lost 96% of its value since the Federal Reserve was created. And this happens with every fiat currency ever made. So every fiat currency, paper money, has always failed. That goes back to the British pound, just every single one. And the dollar's pretty much going to do the same. We just kind of been used to having the reserve currency status and being able to accumulate as much debt as we want. So Americans don't really know a lot of this, and this is why one of the biggest reasons why you want to invest. So as you can see, over time, education, healthcare, cost of living, rent, taxes have skyrocketed. So that kills your wealth. So if your wealth is not growing, those expenses alone are going to kill your wealth. Um, I'm sure y'all have talked to, like, a grandmother or whatnot, and they're like, yeah, a piece of candy, a candy bar, get for like 5 cents, 10 cents, and now it's like $2. So, um, and some people make the argument that, oh, well, we get paid more than we did then, but that's only in nominal terms. So when you say nominal, that means that the number goes up. So people used to get paid $4 an hour. Now, average maybe 27 an hour, depending on where you live. So an average maybe 27 an hour. And they're like, yeah, well, we get paid more. But the thing is that when you were getting paid $4 an hour, you could purchase more goods and services with that $4 than you can with that $29 today. So that has to be adjusted for inflation. It can't just be rely on the nominal number. Another thing is that banks pay you less than 0.5% to hold your money. So whenever you keep your money in the bank, they're not paying you anything to have your money in there. And banks used to pay 6 to 10%. 70s, 80s, it was paying like 10%, and your money could sit there and grow. But now banks don't hardly pay you anything. So when you hold your money in the bank and the cost of goods and services are continuously increasing, you're losing wealth. So that is why you want to beat inflation. That is one of the key things to building wealth. To beat inflation, you need to compound your money at least 6% per year. Inflation, it's the metrics of inflation can be different depending on who you talk to. Especially like the Federal Reserve, they use the consumer price index or consumer price inflation. They measure theirs based off of electronics, like your iPhone and stuff like that. And they'll be like, oh yeah, well, it's only going up at 1.5% per year, 2% per year. But in real terms, in real life, we're seeing the prices of groceries increase. We're seeing the cost of living increase. We're seeing education increase, healthcare increase, all of that. So that isn't even factored into the CPI that the Federal Reserve uses. So that's why I say in order to beat inflation, you must at least compound your money at about 6% per year. So that's why you want to invest. And the cost of goods and services will continue to increase, even as, Tony, you and our kids grow up, the cost of goods and services will increase. I do have concerns about the future, our kids' future, in the sense of the dollar collapsing or things like that, because the system on a global scale is just very fragile, and it's deteriorating and continues to deteriorate. But that's a whole nother discussion. Any questions on this?
You talked about the banks and how, the holding our money, it really, it doesn't really, the percentage wise doesn't really help holding it there. I mean, are you going to discuss like better options later? And maybe not in this episode, but the next one, or?
Yeah. We'll get into that as well. So yeah.
Okay.
All right. So the key thing to building wealth is putting your money to work. So right now, as an employee, Tony, you and I, we trade our time for money. So that means that if we're not spending our time, we're not making money.
Right.
And then also, even as a self-employed, you're spending your time for money. So whether that's you're a lawyer or a doctor or whatnot, you have to trade your time for money. So when you get to the right side of the quadrant, you have the business owner. A lot of times this is a business owner that has employees working for them, or in a system that continuously can grow and pass down to their kids. We've seen, McDonald's and other corporations that pass down businesses and systems to their kids, and their kids can choose to work for the business or not, but it's still going to keep going. And they may just influence decisions as far as like, who's going to be the CEO or who's going to be the executive, stuff like that. But that system is already going. When Ray Kroc made McDonald's, he made a system, and that system continuously goes and goes and goes, and that passes down to his kids, and his kids probably kids and grandkids probably don't have to spend as much time trading their time for money because that system's already going. Same thing with investor. This is your money working for you. So your money is building and compounding in interest and growing. And so that's the investor category. A lot of times people use real estate for passive income, where they buy rental properties and people pay rent, and that's passive income. They don't have to manage it as much, and are getting a consistent check every month. Same thing with dividends, paying stocks that pay you a dividend to hold them. You don't have to work for that. You're not trading your time for that. So like Warren Buffett, for example, he's super billionaire, but I was looking at, I think he bought 500 million worth of Barrick Gold. And I was looking at how many shares he got for that. And then I just multiplied that by the dividend they pay, which they don't pay a super high dividend, but dude's getting like 5 million, or more a year based off just holding those stocks. And so his money, hey, you making a lot of noise. So based off his money, he's just compounding it. It's just sitting there. He's not trading his time for it. He's just holding the money, and the money's working for him. So another thing about this quadrant is that you're going to pay more taxes as an employee and self-employed than you are as a business owner or investor. So remember, taxes is part of inflation. And how that works is that in the tax law, there's loopholes for business owners and investors, because the government gives it tax incentives if you grow agriculture, if you work in the energy field, whether that's oil production or green energy or whatnot, if you provide jobs, which is the business owner side of it, and then if you provide housing, so that's the investor side of it. So the government gives tax incentives for that, and you get a lot more write-offs, and you end up paying less taxes than the employee and self-employed. So when everybody was mad at Trump about his tax returns, even though even though I guess his accountants paid it quarterly, but they came out with the number like, oh, he only paid $750. But I think that was the balance left over because they made some mistake. But he owns a lot of rental properties, so he's not going to pay a lot of taxes because he gets tax incentives through the law. And a lot of wealthy people do that. So the biggest thing is like, how do you decrease your taxes? And in order to decrease your taxes, you have to come over to this other category. Any questions about that? All righty. So what type of investor are you? Are you the type of person that want to take more risk or less risk?
I'm kind of in between. Like, I don't mind risking, but I don't want to put everything into one thing,
Mm-hmm. Okay.
I would say that I'm a little bit more on the riskier side, just because I'm not dealing with as much money. So just because of that, like if I went down a little bit, I still spread on my portfolio a lot. So I'm doing a lot of different kind of riskier things, but I feel like if just half of those do decently, then I'm doing all right.
Okay. Cool. Like I'm probably somewhere in the middle. Usually rule of thumb is that the younger you are, the more risk you can take, because you can bounce back. But the older you are, you want to take less risks. I mean, like Tony and I, we got kids and stuff like that. So you can't, when you're young and you don't have any kids or whatever, like you can take a lot more risk. So you have long-term investors. These are investors like Warren Buffett, who buy and hold stocks. They look at long-term trends of stocks. They evaluate stocks. So they actually determine the valuation through different types of metrics. You have different systems from like Benjamin Graham and I think Peter Lynch may have one or something. But it's like a more intense process when you get to the valuations. I have some simple ways of how I evaluate stocks, but valuations are important. These are a lot of times dividend paying stocks. Usually the biggest dividend paying stocks are like oil stocks and what I've seen like real estate and investment trusts. They're called REITs. Those stocks pay some good dividends as well. And then good company models. So usually long-term investors, they actually look at the company. Okay, why do I want to invest in this company? They go look at the fundamentals of the company. They look at the balance sheets of the company. Does the company have a lot of debt? Does the company bringing in enough income? Is the company over leveraging debt? All those different things. So that is why you look at good company models. Some people even look up the CEO of the company, like, okay, what's this person's history? Okay, did this person manage this company? Did this company succeed under this person when they were managing it? Stuff like that. So usually long-term investors look at good companies and they evaluate them, and it's a lot of work. It does minimize the risk because you are not focused on building you're not focused solely on like growth stocks, such as like, Amazon's a growth stock, stuff like that. So growth stocks, they grow faster, but usually long-term investors, they have a little more of a conservative portfolio, and sometimes they mix it in with growth stocks as well. They just try to make sure they're not over leveraging either. And it usually takes a large amount of capital. So you have to continuously put money in to make it grow. So it can take a large amount of capital. So you have to continuously pay yourself first and make that grow. So when you're a trader or short-term investor, a lot of times they look at short-term trends, which is like, okay, what is it doing over the short term? What is the stock doing? It's a lot of times it's based around hype. So right now there's a lot of hype around GameStop, Tesla, all of that. So they usually run to that. And one thing that I forgot to mention about a lot of long-term investors is that they buy the stocks that are most hated. So usually the stock market goes in cycles based off which companies or which sectors are profiting. So in the 70s, you had the oil sector, oil energy. The 80s, I think you had retail, which was more like grocery stores and stuff like that. And then the 90s, you had the .com, which was tech. You had the internet booming then. And then the early 2000s, you had the financial sector and real estate. And then now we're more in like a tech. We have tech growing, and then we have other stocks like e-commerce and things like that. So those are what's growing the most right now. So usually long-term investors, they go to it's in my audio. My bad, yo. So usually long-term investors they usually go to stocks that are most hated, because eventually everybody's going to run to them. So they run the other way, opposite way of where everybody else is running. So also with short-term trading, you usually pay more taxes, because you have capital gains tax. If you hold a stock less than a year, you are going to pay more taxes on it. Long-term investors are usually a year or longer. And then I think you get even more benefits, tax benefits, if you hold it longer than 5 years. So you're going to pay more taxes on short term. And a lot of times that has to add to your income. So if you made a lot of money off GameStop, people that made a lot of money off it, their tax year next year, they're going to have to add that as income. So if they made $1 million, they're going to pay, 35% of that, and depending on what happens with tax laws and stuff like that. So that could be 350,000. So that's you have the taxes as well. Sometimes with short-term traders, they don't really do valuations. They just do based off how the stock is performing. Um, a lot of stocks right now are overvalued, and people just go based off the hype. They don't look at like, okay, this is a solid company. This company has solid balance sheets and things like that. So sometimes people just trade it based off the hype or just based off like they see the price growing. So a lot of the fundamentals don't matter with traders in short term. It is higher risk, but with higher risk, you get higher reward. Um, and then less capital, and you can invest less money and increase your money a lot, based off doing that. So, and that's kind of like we see that with GameStop and AMC options calls and things like that. So, any questions on this? We going deep, y'all. We're going deep. All right. So another part of investing is protecting your wealth. So you want to protect your wealth by, the reason you want to protect your wealth is because you worked hard for it. And it's like, okay, well, I don't want to, lose everything that I've earned. So you want to protect it. What are some things that you guys think about when you think about protecting your wealth? Are there any things that you do or any things that you know of?
In the future, I want to definitely make sure that I buy a house, buy my own property, and build off of that. I think that that's kind of like step one, and the younger that you can make that is even the better.
Mm-hmm. Okay. Yeah, that's good. Like for me to protect my wealth, it's like, okay, right now while interest rates are low, I'm trying to refinance. That way I can get a lower payment and then also reduce my the amount of interest I pay to the bank, because you're gonna pay more interest, if you don't, pay extra. So yeah. How about you, Tony?
For me, it's just basically, not biting off more than I can chew. So if I lose anything, I'm not devastated. So for me, for protecting it, I just don't put that much. So if I lose anything, it doesn't, impact the family in any way.
Mm-hmm. Okay. Yeah. So protecting your wealth goes two ways. You got kind of just ways to hedge your wealth so that it continues to stay solid, and you got ways that because obviously, Tony, you bring up a good point. Not biting off more than you chew, but you also got to look at inflation. So it's like, okay, like how do you balance that? Because the inflation is going to eat your wealth up on the other side. So I'm going to get into some ways of how you can protect your wealth. My bad, y'all. All right. The key thing is diversity. So diversifying your investments. So what this means is that you want to not have all your eggs in one basket. Same thing with stocks, same thing with anything, because you have different categories of types of investments, and you don't want to have your all your eggs in one basket. So I wouldn't put all my eggs in real estate. I wouldn't put all my eggs in stocks. I wouldn't put all my eggs in like gold and silver. I wouldn't put all my eggs in Bitcoin. So you want to diversify. Another thing is to buy alternative assets, such as, Bitcoin, gold, silver, real estate, commodities, things like that. That helps protect your wealth. Bear market stocks. Tony, I kind of shared that on the thing. So that stock that I showed you on Facebook, those were two stocks that do well when the market is performing poorly. So, so I usually buy bear market stocks because it's like, okay, if the market crashes or if the market, does something, just crazy, goes through a crazy correction or whatnot, I have some insurance by having those bear market stocks where I'm not going to lose as much wealth because of that. Same thing with stop losses. You want to have stop losses on your stocks so that they trigger a sell whenever it reaches a certain point. So you have like the trailing stop loss where, sorry, y'all, this notifications and stuff. So you have your trailing stop losses, which is where they will sell your stock based off a certain percentage that it loses. So a lot of my trailing stop losses are about 20-25%. It's like, okay, I'm willing to lose this. So, and usually if a market crashes, those stocks go down about 80%. I think this last crash in March went about 80%. So if you have stop losses in place, it can trigger a sale at 25% loss, and then you can buy back the shares or whatnot at an even cheaper price. So those are some ways that I hedge. Another way is emergency fund. This is one of the key things that I'm learning is like, okay, I need an emergency fund because the banks aren't paying me anything for it. And there's other ways that you can do your emergency fund, whether that's through a cash value insurance plan or a money market account where it can grow at, 3%, 4%. But an emergency fund is important because you don't want to sell your investments when an emergency occurs, so, your car breakdown or whatever, you don't want to have to liquidate your assets for that. You want to just have that emergency fund there. And precious metals, I mean, that's that's an alternative asset as well. So that's a way to minimize your risk. All right, trying to go forward, not backwards. All right, so different types of investments. Different types are real estate. That's an investment. Usually people think of their home as an investment. It's really not. It's technically a liability until that home is paid off. Liabilities are things that take money out of your pocket. Assets are things that put money in your pocket. So if you have a investment property, real estate will be an asset because it's putting money in your pocket. If you have a tenant in there that is paying you rent for the property. And then liabilities take money out of your pocket. So like, owning a home, I have to pay a mortgage, I have to pay taxes, property taxes, and all those different types of things. So once that home is paid off, it'll be less of a liability. But I will still have to pay taxes and any emergencies and stuff like that. And my kids will have to handle that as well. Bonds and treasuries. So you have corporate bonds, which is pretty much you loaning money to a business and that business paying you back in interest. Then you have government bonds, which is the government, you loaning money to the government and the government paying you back in interest. Same thing with treasuries as well. However, bonds and treasuries don't pay a good percentage right now. So people that buy bonds and treasuries, say like you loan the government money for like 10 years and they're like, okay, we're going to pay you 3%, your money back plus 3%. By that time, inflation could increase a whole lot. The cost of living could increase a whole lot. So you're not going to be able to purchase as much with those dollars that you could before. But that's another type of investment. You have stocks, which is partial ownership of a company. Then you have precious metals such as gold, silver, platinum, palladium, rhodium. All of those gold and silver have been treated money for thousands of years. People have used that gold for over 5,000 years as money. And then so people usually hold gold because say like we do have a financial system crash and what's going to become money? Money's going to become food, water, ammo, it's going to become precious metals. That's what's going to obtain value, because if the dollar loses all of its value, it's just a piece of paper that isn't backed by anything of value. So it's only backed by confidence. So precious metals is a way to, protect your wealth as well. I think I did a video a couple of times where an ounce of gold in 1908 was $20 an ounce. Now an ounce of gold is $1,800 an ounce. versus the dollar that was a dollar then and is a dollar now, but you can buy less with that dollar now than you could then. So it's like pretty much reverse. Um, you have cryptocurrencies, which is, obviously digital currency, Bitcoin, Ethereum, things like that, that are starting to be treated as a store of value. They're still pretty young. I mean, they're not as old as gold. This cryptocurrency is only like 12 years. Um, However, that's an alternative investment, um, and the value behind it is that it's decentralized, which means that it's not controlled by a centralized system of like bankers that can, determine, oh, how much money they print. Bitcoin only has 21 million, but we've skyrocketed how much money we've printed this year or last year. We printed, I think, close to 7 trillion or something like that. So the more money that they print, the less value your money is. So that's why people go to cryptocurrencies. Then you have other forms of investments like art. You have art, whiskey. There's bottles of whiskey, bottles of wine that freaking or go for like $30,000-$40,000. Because, and then you have ammunition. I mean, ammunition have freaking skyrocketed. You got classic cars. Those are pretty valuable. So why do you think those are valuable?
I think part of it is like sentimental value for certain people, and then for ammunition, people might feel like there might be a need.
Mm-hmm. So the biggest thing is scarcity. So precious metals are scarce. Silver, gold, platinum, all of those are scarce metals. Cryptocurrencies are scarce, especially Bitcoin. Bitcoin, there's only 21 million. So once all the Bitcoin are mined, that's it. Art, whiskey, ammo, classic cars, they're scarce. So, those bottles of whiskey that go for $30,000-$40,000, it's hard to come by. Pieces of art that are, like the Mona Lisa, it's hard to come by. Those classic cars, they're hard to come by. So that's what gives them more value. So, versus the dollar we can print as much as we want. So we went from 5 trillion in debt from the first 220 years of the country's existence to now we're over 29 trillion. So you can create as much dollars as you want. So that is why the dollar loses value. However, you can't just create as much gold as you want. We don't know how much is in the earth. We just know that it's scarce from the mines. You can't create more Bitcoin. You can't create more Mona Lisas. Otherwise it's going to lose value. You can't create more whiskey from, however long ago. You can't create more classic cars, that exist. So all those things maintain value because of the scarcity. Any question on that? All right. Any questions in general?
I say, what's like, I feel like it's probably stocks, but like, what's like the first, aside from stocks, that you would want to get to like start diversifying your investments?
Mm-hmm. Yeah, for me, that has been gold, gold and silver, and cryptocurrencies. Right now, I'm kind of over leveraging gold and silver because that is probably the most of my wealth is in there. I do believe that precious metals will go higher, and as people start to see that the dollar is losing so much value, and how much money has been printed because of COVID and the state of our economy. However, gold is technically not an investment. It's supposed to just be a store of value. So gold and precious metals. You also have the industry demand for precious metals, which is the industry demand for like silver. Right now there's a big push for solar energy. Solar panels use silver. Silver scarce. There's a big push for hydrogen fuel cells, cars. That takes platinum. there's a big push for electric vehicles that takes lithium and nickel, which is scarce. So, all of that stuff, like, so you have the industry demand as well. One of the industry demands a lot of people don't know about is rhodium. So rhodium was trading for, I think $700 an ounce a couple of years ago. Now it's over $16,000 an ounce because they had to use it to reduce car emissions. So whenever you have these scarce metals, the commodities of it, these scarce commodities, and the industry needs it, they're going to have to pay more to get it because it's scarce. So that's another way to do that, to invest in outside of stocks, and then also cryptocurrencies. I mostly do Bitcoin because I know Bitcoin has a lot of protection and it's the mother of all cryptocurrencies. However, I do dabble a little bit in Ethereum and Litecoin and a couple others, but most of my money's in Bitcoin, because it doesn't have as much risks as the other coins. I think with Ripple, they can print, or not print, but make as many Ripple as they want, but Bitcoin, it stops at 21 million. It's like, all right, once these are mined, there's no more being mined. If there were to be more being mined, the price of Bitcoin would go down because it would show that it's not as scarce as it was supposed to be, but I don't believe there's more to be mined. So those are other ways that I kind of put wealth in. So I'm always picking different eggs, or buying eggs and putting in a basket, whether that's, okay, let me buy gold this time. Let me buy some Bitcoin. Let me put $20, $30, $100 in Bitcoin. Let me put, $100, $200 in stocks, so I kind of just mix that up. So with gold, you can own paper gold, which is gold stocks. However, there's a saying, if you don't hold it, you don't own it. Same thing with Bitcoin. Bitcoin, I use my own hardware wallet. I don't have it here with me, but I use my own hardware wallet that I place my Bitcoin on. Then I transfer it to exchanges and then cash it out. So I don't leave it on the exchange like Robinhood and such. So this is a hardware wallet that I use. See if I can get it to show. Yeah. So yeah. So this is called Ledger. So what I do is I plug it in and I transfer my Bitcoin over to that wallet. It's called cold storage. And I just let it sit there. And then if I wanted to liquidate it, I would just send it back to like either a Coinbase or another platform and then cash it out. But a lot
What
of
was that called?
It's called Ledger. But a lot of those are, those platforms have been hacked in the past and people have gotten, their crypto stolen and all of that stuff. So that's why I try to reduce counterparty risk. That's another way of protecting your wealth, is reducing counterparty risk. And counterparty risk, banks are part of that counterparty risk. There's a lot of fine print in banks. Banks actually, there was a law implemented in the 1930s during the banking crash that they could do bank holidays where they can close or limit how much money you can take out. And so whenever you have a falling currency, like as in Russia or Venezuela, and you can't take your money out of the banks, then by the time you get your money out, your money has way less value than it did before. And those are like usually in like hyperinflation environments. So banks have counterparty risk as well. So holding your crypto on a platform, holding your money in banks, and owning gold stocks are all like counterparty risks. To reduce that, I do physical gold. I do a hardware wallet for my crypto, and then I keep a little bit lesser money in the bank. I try to keep some money, but you got to have money for emergencies and such. So, but I don't put everything in there. All right. Any other questions? All right. So just appreciate y'all support. I do have a Patreon. If y'all interested, y'all can donate monthly, $10, $20. So I do have some different services that I'm offering with that. It comes with, I have a friend who I'm partnering with, who's a financial planner, who will sit with you, make a plan, and go through investments and things like that with you, which is very key. Which is, what I'm doing right now is I'm using my friend as my own financial planner as well. And then obviously, I have YouTube, Facebook, Instagram, Twitter, which I think y'all follow. So, but for those who are not following that are watching these are ways that you can support the show. All right, y'all.